We have a lot of things to talk about all the way from 2018 up until this current present time. And we look forward to, of course, joining our main man of the moment, Kanish Chugh from ETF Securities. Kanish, welcome back to the show.
Thank you, David.
So Kanish, where do we stack up for what happened in 2018?
Yeah, it's interesting. So globally and domestically, when you talk about the ETF market size, globally ETF markets were actually pretty much just under their 2017 end. So they didn't grow in size. Here in Australia, where the market is just a tick under 42 billion. So it did grow because the 2017 market end was about 36 billion. So there is some growth there. But what the interesting thing was, a lot of that growth was more flows. So there was obviously that volatility towards the back end of 2018, and that actually took out a lot of the assets in the total market, and it was mainly all flow driven. So that was the second largest year by flows that we've seen in the ETF market since 2017 was the highest ever, but 2018 was the second highest, which was interesting.
So how does that all then stack up into the month of Jan? We've brought over the Christmas period and we're all done with that now, but what are we left with?
Well, if you look at the back end of 2018, it was just, we saw a lot of volatility in equity markets, both here in Australia, but obviously, in the US and around the world. In 2019, when we're kicking it off, that actually has been positive for markets. So what we've seen on the ETF side, we've actually seen most of the volume and most of the flows has been in just broad-based market trackers, whether that's STW, so the State Street ASX 200 ETF. We've seen the AAA, so the BTS cash product, has seen significant flows. And then the other thing has been is there's a bit of a flight to defensives. So whilst we're seeing positive markets for the beginning of 2019, there's still a little bit of fear. You've got the US government shutdown, I think, hitting record days. You've still got the trade wars with China. There seems to be a bit of a positive tilt on that. Brexit, not sure what's going on. There's still a little bit of an overhang, still a bit of a question mark for 2019. So people, I think, are playing a bit more safe and just saying, well, let's move the broad base of building blocks of our portfolio. And then on the defensives, let's just start looking at, so gold globally had record inflows in terms of underlying holdings in ETFs. So that's something to indicate, well, globally, investors are going towards some of those safe haven.
So Kanish, the age-old debate, it's still going, active versus passive in the ETF world. Is there any value in active managers for 2019?
There was an article recently produced by the AFR, and it talked about a survey on active managers and how do they perform against their passive broad benchmarks. And it actually looked and said, look, if you take the Vanguard Australian Equity ASX 300 Index, the ETF is VAS, and you compare that to a broad range of large cap Australian equity active managers, 85% of those active managers underperformed that ASX 300 benchmark. So what are you paying for there? And I think that's a question investors need to ask themselves. If you're going towards an active manager, you have to have belief in that active manager. Now, a lot of these active managers for a large part of 2-3 years, there's been this big flight to index and broad indexes. Everyone's been saying, when we see some volatility, that's when those ETFs will really, reduce your performance. That's when you're going to get hurt. And what did we see in that back end of last 2018? It was the indexes, the market trackers, some of those rules-based ETFs as well, outperform a majority of active managers. So I'd say that argument is somewhat flawed. And so from an investor perspective, really take a belief in, if you're paying for an active manager, you're paying 70 basis points plus, or even up to 1% of fees. What are you paying for? And is there an alternative, or can you diversify that exposure with an ETF, whether it's a market tracker or a rules-based approach, to try and bring down the cost of your portfolio and maybe even protect your portfolio during times of volatility?
And Kanish, in market uncertainty, downturns, whatever you call it, people tend to look at those safe haven metals such as gold. It's one of the oldest asset classes in the world.
It's interesting. When we talk to investors in Australia and we ask them, would you invest in precious metals? So when I talk about precious metals, that's gold, silver, platinum, or palladium. Would you invest in them? And a lot of them would say, no, I wouldn't. I would invest in the miner, but I don't understand what influences the price of some of those metals. Now, gold has always been that safe haven asset. So when we see equity market volatility, when we have certain geopolitical risk, with Brexit, with government shutdowns, there is this big flight to gold globally. And in Australia, that's something that as ETF Securities, that's what we're trying to talk about. Just to say, This is a good diversifier in portfolios to lower the risk of your portfolio and potentially just provide you a bit of downside protection. So when markets do get choppy, and we did see that towards December of 2018, gold does generally outperform equity markets. But in 2018, if I was to ask all the sort of listeners and viewers, what was the best performing ETF in the Australian market? It was the Palladium ETF. So physical palladium. When we looked at the performance to the week ending of 18th of January over 12 months, it was up more than 37%. So that was the best performing ETF across all ETFs on the ASX, but yet doesn't receive much interest, doesn't receive much flows. But why is that? So do we know what actually drives the supply and demand of palladium? 80% of palladium is actually used in automobile industry. So it's in the catalytic converters. So basically in a lot of petrol vehicles with emission standards rising, this is where that demand for palladium has increased, and there's a supply deficit. So Citigroup have come out and said there may be a supply deficit up until about 2021 because a lot of the mines are centralized in Russia and South Africa. So because of that supply deficit, increased demand because of increased environmental standards, they're seeing a drive towards palladium, and that's actually now palladium currently is more expensive than gold.
So how does this fare into trading volume? Could you give us a bit of an insight as to what you see there as well?
Look, still, as I mentioned, from over 2018, it was very much amongst a broad, plain vanilla sort of market trackers. Your S&P 500s, your MSCI World, ETF tracking products, and that still carried on in for the year so far. We're still seeing that. And as I said before, I think it's more around investors just moving around the building blocks, just positioning themselves and just waiting to see where should they invest for the year. Where do they potentially see value? And that's where you may see some trading pick up in some of the thematic ETFs, some of the smart beta ETFs later on.
And Kanish, credit where credit is due, and also to highlight the unfortunate death of Jack Bogle. Jack Bogle passed away at the ripe age of 89, but he has still very much left his DNA within the market. And I think being the pioneer of index investing.
Well, I think it's interesting, any investor that's currently invested in a fund, whether it's an ETF, a mutual fund, whether it's passive or active, should pay credit to Jack Bogle and what he did, over 50 years ago, because his whole idea was pioneering the way to invest for investors. The idea of bringing down the cost of some of these exposures, which we now see very much in Australia. We're so fee conscious. So that was something that is carried over both on the active side and the passive side. And then on the passive side, just the fact that, the pioneer of indexing. So anyone that's invested in an ETF has to pay credit to Jack Bogle and the work that he did.
Kanish, thank you very much again for coming in, mate. It's always good to get an update, and also we actually had a chance to talk about some real topical issues and things that we're seeing at the moment. So thank you very much.
No worries, thanks Dave.
And thank you very much for tuning in. It's great to have you back with us for 2019, and we look forward to seeing you in the next one.